Okay, welcome back to the third recording of chapter 4, and then there will be a fourth one. I know there's a lot of content, so in this one we're gonna talk about accounting changes and other comprehensive income, and then in the fourth portion we're gonna talk about the cash flow statement and ratio analysis. Okay. So basically, first of all, accounting changes fall into three category, right? So first category is called a changing in accounting principle, and second one is changing estimation, and third is changing reporting entity. And one thing I wanted to you guys to notice is that correction of an error is another adjustment that is accounted for in the same way as a certain accounting changes. And then what is a changing accounting principle? It refers to a change from one accepted accounting principle to another, right? So there's a mandate changing and there's a voluntary changing as well. So the mandate changes in accounting principle stands for FASB require certain implementation of a new accounting principle. So sometimes the FASB requires a changing in accounting principle, and these changes in accounting principle potentially hammer the ability of external users to compare financial information among the reporting period, right? And so because information lack of consistency, remember, it's an important qualitative characteristic in the conceptual framework. And the board considers the factors such as this, as well as the cost and complexity of adopting the mandatory changes of accounting principles, and then choose the various approach that allow companies to adopt. And then first of all, there's a retrospective, right? And then there's a modified retrospective, and then third one is a prospective approach. And what is a retrospective approach? It means that a new standard is applied to all periods, right? Periods presenting the financial statement. That's amazing. Like, say if your companies start to publicly disclose information in 1951, that means because the implementation of this new accounting standards or principles, then you got to have to restate everything since 1951. And so as if the new method has been used since 1951. And then the company need to revise the balances of each amount that was affected to make those statements appear as if a newly adopted accounting method has been applied all along. Okay. And second method called a modified retrospective method. The new standard is applied to, in this method, the new standards only apply to the adoption period. Only. Okay. So prior periods of financial statement are not need to be restated. And then the question is, okay, then how we being comparative? Good question. So the cumulative effect of the changes on the prior period's net income is an adjustment to the beginning balance of retained earning. Okay, so in other words, that you can in terms of modified retrospective approaches, that you will apply this new standards but change the new principle that you want to use to adoption period. Regarding the accumulative effect of the changes towards the prior period, you can do one adjustment on the beginning return earning on the first year of adoption period. Okay. And the prospective approach is that it requires neither modification of prior periods financial statement nor adjustment to any balances of any accounts. Instead, this kind of changes can just simply implemented in the current period or the future period. Okay. If, for example, occasionally without being required fast, right, a company will changing from one general accepted principle to another. For example, companies like to changing the inventory costing method from LIFO to FIFO, or so in this occasion, inventory and cost of goods sold are measured in one reporting period using LIFO, but then in another period using FIFO. So these two periods are not comparable, right? So to improve comparability and the consistency gap typically requires that voluntary changes of accounting principles to conducting retrospectively. So in other words, it's really expensive. Okay. And then let's talk about the specifically one changes that I want to mention here. It's changes in depreciation, amortization, or depletion method. So why is this thing needs to be talked about alone? Is because these changes is considered as accounting estimation changes, but it has to be achieved by changing accounting principle. In other words, it's considered, if you ever change anything, we all know it's because your estimation of depreciation speed or residual value of the asset is changed. However, it has to be achieved by reporting that as you are changing accounting principle. And also, the good thing about this change is that it's accounted prospectively, meaning that you don't need to retrospectively to restate it, return earnings and stuff related to the method. And then it's counted as the same way as changing accounting estimates, and we're going to talk about it in 1 minute. So one difference is that the most changes in estimate does not require a company to justify the changes, but because you changing depreciation, amortization, and depletion is considered as a changing of accounting principle, although the treatment is equals the accounting estimate treatment, right? Changing accounting estimate means prospectively, but you still need to justify. So in nutshell, if you want to changing the accounting principle, right, then you need to justify your reason, and also you have to adopting either retrospective, modified retrospective. But in the only special thing about depreciation is that you are treating it as accounting estimate changes. However, it is one kind of accounting principle changes. Okay. So now let's look at the changes in accounting estimates. Changing in accounting estimates are changing due to modification of estimates as new information comes to light, right? As we know that estimates are necessary aspect of accounting. A few of the more common accounting estimating are the amount of future bad debt expenses that you are estimating, and the useful life and residual value of depreciable assets and future warranty expenses. Those are all the estimation is based accounting treatment, right? Because the estimation require prediction of future events, it's not unusual for them to turn out to be wrong, right? So when an estimate is modified as new information comes to light, and accounting for changes in estimate is quite straightforward, because you only need to do it prospectively, meaning that when you know something new, then you want to change your estimation, you can do it in the current period or the future period. You don't need to retrospectively changing anything. If the effect of changing is material, a disclosure note is needed to describe the change and the effect on the both income and earnings per share. Okay. And the examples that I want to give that I kind of mentioned is for example, future bad debts on existing accounts receivable, or the useful life or residual of the depreciable assets, or future warranty expenses. And then the next thing that I want to talk about is how to correction accounting errors. And the accounting errors is it occurs when the transactions are either recorded incorrectly or not recorded at all, right? So either you forget to record it or didn't record it correctly. So the errors discovered in the same year that you made those errors, right? You can use an erroneous journal entry to reverse it, and then the appropriate journal entry will be recorded. But if unfortunately you didn't find that errors and you found it in subsequent, let's say next 10 years, then you find, oh, 10 years ago I made such big mistakes, then prior period adjustments has to be recorded if the error is so material, okay? And then next thing you say, what do you mean prior period adjustment? Good question. Prior period adjustment is required, right, when a material error is discovered in a statement that has been published and distributed to a shareholder. In other words, assume that after its financial statement are published and distributed to the users, there's a company discovers a very big amount of errors in its financial statement 5 years ago. And how can they change? What are they going to do about this? And this company must take a prior period adjustment, and the company would record a journal entry that adjusts any balances. Okay, require the company to record a journal entry that adjusts any balances sheet accounts to the appropriate level and accounts for the income effects of the error by increasing or decreasing the beginning retained earning of the balance of the period that they find this mistake. And also a disclosure notes to communicate the impact of the errors on the period's net income, right? Okay, so think about it. Simply reporting a corrected return earning amount might cause a misunderstanding. In addition, right, if you only say, okay, let me change my beginning return earning in the statement of equity, like just change it, and then say last year was because without detecting this error was $2,000, and right now without telling anybody anything, you're changing this to $1,900. And some people gonna remember, wait a sec, last year the return earning was 2,000. How come this year started with a beginning return earning of 1,900? Good question. Therefore, in order to avoid misunderstanding for some investors who are familiar with the previous reported amount, the company need explicitly starting with the still $2,000, and in the returned earning column, right, of the statement of equity, and then explicitly say minus the error made in 2015, right? So then you minus the 100. So explicitly reporting a prior year adjustment in a statement of stockholder equity to highlight the adjustment and avoid such confusion. Okay, so with after that, let's look into, we almost talk about everything about related to how to come up with a net income number, right? And the net income number is contributing from continuing operation, right, and the discontinuing operation. And then in the continuing operation, we have operating income and other income or expenses, right? And we said operating income has a quality which is more predictable, or we can even call it permanent income, rather than other income is they call it incidental income, right? And the discontinued operations, it has a specific rule that what can be considered as a discontinued operation. At the same time, they needed to report it separately from continuing operation, right? So this is already, and then we talk about what could be the accounting adjustment towards the items that was included in the net income that has to be restated, right? Okay, so the next topic we wanted to talk about is earning per share. Net income is reported in a total dollar amount, right? The dollar of revenue minus total expenses, and representing the total profits of the company has generated for all shareholders for that period. However, for individual decision makers, right, investors maybe want to know how much profit has been generating for each share of the common stock they own. To know this, we have to calculate earnings per share ratio that to relate the amount of the net income, right, and a company generating to the number of common share outstanding. And how do we calculate it? So we have a two kind of EPS. I call it earnings per share, and we call it EPS. So one is the basic EPS, another one is called a diluted EPS. And then it's required to report on the face of the income statement. And the basic EPS is net income minus the preferred stock dividend, and then dividing weighted average number of common shares outstanding. So I believe this has been covered in financial accounting, but I do want to emphasize this weighted average number of common share outstanding. What do you mean weighted average? Okay, the weights we are applying here is time. In other words, there is the number of shares outstanding has been constantly changing over the years, right? So sometimes the firm declare new issuance of the stocks, like say in July, right, or August. So portion of the outstanding share as of December 31st are not 100% outstanding throughout the year. Hence that we want to weight those shares and then into the total number of shares as the denominator. Right. So for example, this is the case that the company actually declared 1 million shares in March, right? So therefore, they had 1 million shares in the beginning of the year, and then they declare extra 1 million during March, and hence that the outstanding shares for this extra 1 million is only 9 months out of 12. Okay. And then what is diluted earning per share? Diluted earning per share is incorporating the dilutive effect of all potential common shares in the calculation of EPS. So what is the dilutive effect that here really meant? The dilutive effect refers to the reduction in the EPS that occurs only because the number of common shares outstanding increases, right? And then the potential reason that those numbers would increase is because company may have a certain security outstanding that could be converted into common shares, or they could have a stock option outstanding. In other words, when you are granting people stock options, although right now it was not outstanding those shares, but once the option was exercised, those shares can be outstanding shares. And then because these items could cause the number of shares in the denominator significantly increases, hence they will potentially decreases EPS. That's why it's called diluted EPS. Okay, so let's look at an example of Abbott, right? Comparing to 2015 and 2016, and then look at their EPS. The basic EPS in 2015 was $1.73, right? From continuing operation. From discontinued operations, 1.21. So therefore, the net income based EPS is $2.94. But once you consider that the potential securities out there, or options out there, or instruments out there to make potentially to increase outstanding shares, and then we find that the continued operations and earnings per share decreased from 1.73 to 1.72, and discontinued operation earnings per share decreased another 0.01 cents as well, right? Okay. So let's look at the concept check. So which of the following represent the changing accounting principle? A, using journal entry to correct the misstatement. That's not the accounting principle change, that's error, right? B, changing inventory costing method from LIFO and to average cost. Yes, exactly, right? Changing LIFO to average cost method is a principal change, right? Modifying the amount of bad debt expenses in accounts receivable as new information comes to customers' insolvency is obtained. This is is an estimation change, right? And we apply prospectively. And correcting a material error, so that's error. So definitely choose B. Okay, so after we talk about net income and EPS, the next thing that we want to address is comprehensive income, and I believe this is the content that financial accounting was not heavily stressed in last class that you had. And then what is comprehensive income? Okay, it's a comprehensive income related to the transaction with the owners, including issue stocks to the shareholder or decreasing equity by purchasing stock from the shareholder and paying dividend, or others changes in equity. Okay, changes in equity during a period arising from non-owners sources are representing comprehensive income. In other words, if you remember, in terms of stockholder equity, remember that is equals the returned earning plus common stockholder equity, right? So common stocks is the ones that you inviting the shareholders to buy or sell, right? And returned earnings are related to the net income and the internal generating fund that can funding the operation of the company, or in other words, those returned earnings that can be shared or distributed to the shareholders. Therefore, transactions with owners, right? You deal with owners. These two things are you deal with owners, including issue stocks to shareholder and decreasing equity by purchasing stock back, or such as treasury stock from shareholders, or paying dividend, and all any other changes in equity during period arise from non-owner sources are representing comprehensive income. So in other words, comprehensive income equals net income plus other comprehensive income. And there are a few gains and losses that are not reported in the income statement. These other gains and losses are reported in the other comprehensive income items, such as net unrealized holdings gain and losses on the investment, gains and losses from a post-retirement benefit plan, deferred gains or losses from derivatives, and foreign currency translation adjustments. In other words, the transactions and events that lead to changes in equity, right, from non-owner sources are recorded as revenues, expenses, gains, and losses for the period. You are already familiar with many of these items. They're reported in the income statements and are used to calculating net income, right? However, there's a few gains and losses that are not reporting to the net income statement, but nonetheless affect equity as well. So those other gains and losses are reported in other comprehensive income section. Therefore, the broader concept of a comprehensive income includes net income plus other comprehensive income. So regarding other comprehensive income, a lot of accounting professionals has engaged in a debate concerning what kind of gains or losses should be included in the other comprehensive income rather than net income. And then in example, in chapter 12, you will learn that investment in certain securities are reported in the balance sheet at a fair value. The gains and losses from adjusting the investment to its fair value are considered to be unrealized because the security has been sold. So for example, this one. And for many debts and equity securities, these unrealized gains and losses are included in net income. However, for certain investment in debt security, also known as available sale for debt security, unrealized gains and losses are reported as other comprehensive income in the shareholder equity. And currently, FASB established no conceptual basis for determining which gains and losses qualifies for net income or which ones qualify for other comprehensive income. So therefore, to help avoid confusion about which amount including net income versus OCI, companies are required to provide the reconciliation between the net income and the other two comprehensive income. And in terms of how do we report comprehensive income, there's a very flexible. First of all, information in income statement and other comprehensive income can be presented in two ways. They can singly continuous statement of a comprehensive income, or you can present in two separate but consecutive statements. And if you choose only one way, one time to list out everything, it's called one statement, single statement, and you will call that statement a statement of comprehensive income. If you took two separate statements, you have to put them together, shoulder to shoulder. One lists the income statement, one state for statement of comprehensive income. So let's see this example. This is a comprehensive income as a separate example, right? So first of all, you have a report of income statement that has a net income number here already for number this, and then you directly copy it to the comprehensive income as a separate statement, and then you listed the other comprehensive income such as gain and losses on debt security, gains and losses on projected benefit obligation, gains and losses on derivatives, foreign currency translation adjustment, and all of this you call the total other OCI total, and then you presenting a comprehensive income number. And then as an example, let's look at Astronover Inc.'s 2017 versus 2016's other comprehensive income, comprehensive statement of comprehensive income statements. So you can see net income is listed above, and other comprehensive income was listed calculating as 2016 is 276,000 and 2017 is negative 18,000. Hence that the comprehensive income in 2017 is a little bit less than 2016. Okay, and then also in terms of how do we presenting other comprehensive income in the balance sheet, we wanted to report other comprehensive income on a cumulative basis in the balance sheet, and then we report it as an additional component for shareholders' equity, meaning that remember that statement we have common stocks, we have return earning, so now you will add OCI, right, and then you can have a beginning balance and ending balance, right? So you have an extra column, right, in the reported as a statement of equity, and it should be consistent with how cumulative net income work in the balance sheet, right? Remember, we say that the beginning return earning plus the net income minus dividend equals ending, right, return earning. Similarly, so cumulative operating other comprehensive income also have a beginning balance plus changing in other comprehensive income and equals ending of accumulated other comprehensive income, right? So and then this number is gonna be live in the equity section of the balance sheet. Let's look at this one. So this is the balance sheet of Astronover in 2017. See, as we look in the equity section, we have common stocks we learned, and additional paid-in capital, and the return earning we just talked about, and treasury stock that is bought back, right? So we know that. And then this is extra items that accumulated other comprehensive income would have a negative 975,000 and a negative 1,056. And how did we get there? So if you look at this one, is a statement of equity equity statement, right? So it has a return earning column, it has a accumulated other comprehensive income. In 2016, this is a 2017 statement of equity, right? And then so therefore the beginning balance is 2,975 for 2016, and then hence the ending balance of 2017 is gonna be 1056, because during this whole year the OCI equals negative 81, the changing of OCI, right? So exactly the same way acting as the returned earning is just accumulated other comprehensive income also lives on the balance sheet. Okay. Relationship between the net income and other comprehensive income, there's a different way we can understand it, right? So basically, in the, let's say in the statement of equity, right? So consider there's a 10 million net of tax gain from the other comprehensive income. So if you report it as a part of the net income, right? So that means that your returned earning gonna become $10 million higher, and then your other comprehensive income didn't change, right? So but the total of the comprehensive income still 800. And another way that you can treat it is that treat it report as a part of the OCI, which that you do not put the 10 million on the net income line, but you put this 10 million on the other comprehensive income. Hence that what happened is that this way, if you consider this 10 million is not recurring and it's accumulative other comprehensive income, so this number, the net income number here, and returned earning number here is more comparable with the prior years, rather than if you do what we did earlier, you put inside of the net income, so this number might not be really comparable with last year. Okay, so what's the difference between international financial standards in terms of comprehensive income presentation? So in the US GAAP, the companies can allowed to report comprehensive income in either single statement of comprehensive income or two separate statements that we show earlier, but there has to be consecutive statements. And IFRS is almost exactly same as under US GAAP, but an additional OCI item, changing a revaluation surplus, is possible under IFRS and not possible under US GAAP. And what does that mean, changes in the evaluation surplus, right? So it's in chapter 11, right? We will learn that in IAS, International Accounting Standard number 16, it permits the companies to value the PP&E, which is property, plant, and equipment, at a cost less than cumulative depreciation, which is what we learned, right? It's called the cost of book cost minus the accumulated depreciation. This is one way you can measure it, and second way you can measure it is at the fair value. So therefore, and then also IAS number 38 told us that a similar option for valuation of intangible asset as well, assets. So therefore, in the re-evaluation, right, revaluation options is chosen for fair value method, and then when the fair value is higher than the book value, if you are under IFRS, you can recognize that part of under the other comprehensive income under IFRS, okay, but it's not allowed under GAAP. Okay, so let's do a quick concept check. Which of the following is not an example of other comprehensive income, right? So income from sales is definitely not, because this is the net income, right? Is not something unrelated to the owners. But however, unrealized loss on the security available for sale, yes, because it's unrealized. And foreign currency translation, yes. And deferred gains from derivative, yes. Okay, so I will do another video on the statement of a cash flow and the ratio analysis. So I will see you guys in next video. Thank you.